Bloomberg Audio Studios. Podcasts, radio, news.
Let's talk about some economics because we're actually government back open. Economic data is flowing here, so let's get at it. Jennifer Lee, BMO Capital Markets Senior Economist, joins us here. Jennifer, thanks so much for joining us here. What's kind of your setup for the economic call here for the U.S. in 2026? How are you thinking about that?
Well, good morning. Happy holidays to you both, and thank you very much for having me on. So I will say I'm a little bit more optimistic now than I was, back in April during Liberation Day, given just that we have at least more certainty, a little bit more clarity on the tariff front in terms of what the levels are. We're not talking about 50% anymore or anything like that. Whether or not they're legal is another story, but that sets up for at least a firmer, I think, a start to the year. We know what to expect, but that's not to say that there are lots of landmines in store for us in 2026, and just a lot of them coming in January in particular.
It's interesting. I'd love your take, Jennifer, on what data to look at. Look, in between Christmas and New Year, it's pretty thin, but we have had a little dose of it. US December Dallas Fed Manufacturing Index fell to negative 10.9 today. The expectation had been for negative 6, and that's more about the manufacturing focus over there in Texas. But we're also seeing some of the pending home sales coming in much stronger than had been anticipated on a month-on-month basis. We're up 3.3% if you looked at that number that broke at 10 a.m. What is the tell for you going into 2026? What are the key data points that you want to look at?
So I'll be looking at, I think everybody else will be looking at anything that's related to jobs, anything that's related to inflation. Funny you mentioning the data, because we finally got the Q3 GDP numbers out of the U.S.
They were good.
Was last week, right? Yeah, 4.3%, which was like, whoa, blew me away. And it wasn't just, exports, it wasn't just inventories or anything like that. It was pretty broad-based. Very interesting take, for example, from the consumer side. A lot more spending on that side, not just on, it was just pretty broad-based as well, but a lot on non-durables and also on services. So, we can't discount the consumer just yet, but at the same time, all that's a big look in the rearview mirror. That was all Q3, and now we're looking at Q4, and of course, as we're starting Q1 in just a few days. But we have to get through this period of still not clean data. It still has to be scrubbed. I think we're going to be looking for a lot more revisions. It'll be interesting. The first take, of course, and all the regional data and all that will make for a very interesting story. But I'm going to be more interested in the government data and what is going to happen after they revise them in the months ahead to see what the real story is going to be. But so far, as of the first 3 quarters of the year, a very strong, a very resilient U.S. economy still, and it's going to get messy because of the shutdown that we had in Q4. We're going to have that bounce back in Q1, but at the same time, we can't break out the bubbly just yet, because we could be talking about shutdown again in the next couple of weeks. Sorry to say that.
Exactly.
Sorry to put a dampener on all this, but yeah, that's the reality.
That's out there. So talk to us about the consumer out there, Jennifer. How do you see the consumer? I know we've got that K-shaped economy out there, so maybe we've got to, hem and haw it a little bit, but it seems like the consumer's doing okay. Is that what you're seeing?
So far, again, we got the latest data that we got was from the retail sales report. The core measure was very strong, sets up for still a strong quarter for this consumer, but still, we have to be careful because of the shutdown and all that. At the same time, I'm very wary of the confidence surveys that we've been seeing. And they can swing back and forth, but just particularly what we saw from the Conference Board survey that had that dropped, considerably, but, it wasn't about inflation, because the inflation expectations component, I believe, was quite steady, but it was all about jobs, and fewer people were saying that they found jobs plentiful. More people were saying that they are finding jobs hard to get. So that's something that we have to be very wary about, because obviously at the end of the day, it's having a job, having a steady income that's going to be what is the main driver for the consumer.
And the main driver for the Fed. We're going to talk a lot more about the consumer after the next break. But talk to us, Jennifer, a little bit about one of the key issues you think we should be tiptoeing around is who is going to lead the Fed next and how they react to the data that they're given to. So it's going to be early January that we're going to be anticipating which Kevin it'll be.
Right, yeah, exactly. We do know for sure that is going to be, his first name will be Kevin. The last name is to be decided. But, it's going to be, he will have a very difficult job finding its way through the data. Obviously the analysis will be very important, but also getting some sort of a majority within all the Fed voters, because as we saw from the last Fed vote, there are quite a few that are not so confident that they are ready to cut rates again or just yet. We are not looking for a January rate cut by any measure. I don't think anyone is right now, but I think a couple more at the minimum rate cuts to come at a slower pace. We're looking at March, June, and September for the next rate cuts. 3 more to come. Everything obviously will be taken on a meeting by meeting basis and will be very data dependent. But having that majority will be very critical.
Jennifer, just when it seems like the market may have put tariffs in the rearview mirror, USMCA talks officially launch mid-January. I mean, what's going to happen there? I mean, you've got a unique perspective up there in Canada. What's the expectation?
I think expectations, I'm going to say, from my perspective, I think they're kind of low right now. Not sure exactly what's going to happen, whether or not we're going to actually have an actual USMCA per se, or is it going to be a USC, CM, a USM, you know what I mean? Some type of combination of that. But obviously there is going to be a lot of give and take from all parties. It's just going to be how much, how much each party will be giving or taking will be critical. But it will definitely be a lot different, I think, than what we have right now.
Let's talk more global perspective now, because you've got some great takes on global central banks, not just what's happening at the Fed. The Bank of Canada, 2024 was a big year for rate cuts. In fact, 100 bips were done in 2025. Are we now done until those trade talks are a washout?
So it sounds like the bank from Governor Macklem basically sounds like that they are done, that they're quite comfortable. The words were like that they think that rates are about right where they are right now to get inflation back down to target. So, at the bare minimum, it sounds like nothing is going to happen. But I think if there is a risk, the risk will be more cuts. Again, given how the USMCA fares. I mean, the U.S. is our biggest, by far, trading partner out there, with about 3/4 of our exports going to the U.S., over 50% of all imports coming from the U.S. So many businesses are very dependent on what happens. So at that point, because of that, we do believe that how the talks fare will determine what happens with the Bank of Canada and, of course, with inflation in the economy.
How about, what's your dollar call here for 2026? The dollar has not bounced back like stocks have bounced back and other parts of the market have bounced back.
That has been one of the toughest calls, I'll tell you, to make on the calls on the U.S. dollar. It's been like the U.S. economy quite resilient, but you would imagine, in theory, in a world where almost all the central banks are basically finished easing policy, maybe one more to go, maybe a couple more to go, and some of them are getting ready to start to tighten or continue tightening. In the case of the Bank of Japan, in that kind of environment, and then of course with the Fed still on an easing bias, you would imagine that the U.S. dollar would start to weaken. But it's sort of like how it's going to be all relative to everybody else in terms of the economy. If the U.S. economy continues to remain resilient, which we still expect, and we've got about 2% growth penciled in for 2026, that will actually help support the U.S. dollar. So even though we do look for the U.S. dollar to weaken, it's going to be a slow, softish weakening trend, not a big drop.
Jennifer Lee, I'm pleased to say, of BMO Capital Markets.